This video will cover interest rates. Specifically, we'll discuss the yield curve. We'll introduce and value zeros and strips. We'll introduce the mechanics of how TIPS, Treasury Inflation Protected Securities, work. We'll compute and interpret forward rates. And then we'll show that long rates are a function of a series of current and expected future short rates. Okay, let's start off looking at the U.S. Treasury yield curve right from the Wall Street Journal. Get a little background and context for what we're going to be doing in this chapter. First off, we're looking at various Treasury securities on the left. I took a snapshot from the Wall Street Journal, and this is it. And we're looking at the left table here. This table is what's used to build the yield curve. And the table is in a sense upside down. As you can see, the first row is the 30-year bond. That's a 30-year Treasury bond. Notice in the second column there, 1.25 coupon. That's the cash flow the bond generates. So bonds are usually denominated in $1,000 increments. That's usually the way we're going to be working with it here in this chapter and the next chapter. $1,000 increments. So a 1.25% coupon means the bond pays $12.50 per year. Most bonds, including treasuries, pay semi-annually. So this bond will generate $6.25 every 6 months. Now, the third column here is the price change. Now that price change is 1 and 23/30. That translates into about a $17 drop in the price for the day. And I'll do the math on that in the next chapter. In the beginning of the next chapter, we'll talk about how to calculate bond price changes and the convention of chopping prices up by 30 seconds. It's a little strange. We have to get used to it. The bond market's been around a very long time. They've used these conventions that probably started in the 1800s or even earlier. So what that means is, again, that the price change here was a $17 drop, which is pretty significant. And the reason for that was the Bureau of Labor Statistics that morning released a CPI number. In other words, the Consumer Price Index for the previous month, the month of July. And it showed that the CPI was up a bit. And Consumer Price Index measures inflation. So that when there's a pop in the CPI, that means there's a pop in inflation. Well, that means since interest rates, the nominal interest rates that we're looking here, are a function of real rates plus an inflation premium, the inflation premium went up, and then the nominal yield went up, as you can see in the very right hand, the very right hand part of the table there, numbers. It's green, it went up. And so when yields go up, you know that prices go down. There's an inverse relationship, which is why you see what's in the red or the orange column there for price changes as being negative translates into a positive yield in green on the last column of numbers in the table. Then so also you see the 30-year bond is generating a yield of, that's a yield to maturity, of about 1.376. 1.4% is the yield per year on a treasury bond. Not very much. Now, you can go down to a 10-year, a 7-year, a 5-year, and then notice when you get down towards the bottom, there are treasury bills that have no coupons. They're called zeros. That's why there's a zero there. It's zero because they're zero coupon bonds. So you have those zeros, and then you have the yields associated with the zeros. The yields are really small. They're basically touching zero at 0.1%, or more or less here, 0.1%. That's not very much in return. And on the right here, you have, in this example, the 7-year note. And the reason why the 7-year note is being portrayed here is because highlighted in this table, as you can see, is the 7-year note. When you highlight the 7-year note, the picture on the right shows you a graph. Now you got to keep in mind, this is a little confusing, is that the table on the left is as of August 12th. And the graph that you see on the right for the 7-year note as of August 12th and 13th. And so you have, if you look closely, there's 6 p.m., which is the August 12th. That's the close, that's evening of the 12th. Then overnight, there's some action because the markets are open around the world overnight, and there's treasury securities being traded at those times. And so interest rates dropped overnight, And then they kind of settled off early in the morning, and then starting around 6 a.m., they started to come back up a little bit. Not very much, but a little bit. Let me move over to a 10-year note. So here we have the 10-year note graph, time series, meaning over time for the yields. And then we're looking at the right-hand graph here. And so you see about 3 years ago, 10-year rates were about 2%, little over 2%, crept up over 3% and come down all the way down into July. It's now August of 2020. And so you see a pretty significant drop in rates in that time period, which means, you should be able to look at this and translate that as an investor, what that means. And what that means is that, look, we had a good bull market in this time period. There had to be a good bull market. While the coupon yields are kind of small, the total return had to be pretty good because this is signaling some good capital gains. So if we went to, say, the S&P here, so this is the S&P U.S. Treasury bond 10-year current index return, right? Over the past year to date, year to date, from January 2020 to August 2020, it was 13%. That's a pretty good return. Let's see. And over the past year was almost 12%. And 3 years is a little less because you're going back into a time period where yields were actually going up a little bit 3 years ago. As you can see right here, you can see that 3 years ago, that hurt returns a bit because that was negative capital gains here. There were some capital losses. So let's go and look at 1 month and 3 month Treasury bills and see what we can learn from them. So come here. Look at the 1 month Treasury bill over the last 3 years. It was 1% 3 years ago, crept up to about 2.5%, and then it was below 2 when the coronavirus hit. Look at the big drop off, all the way down to almost 0 if you look at that closely. In fact, it looked like it went negative for a little bit. And that big drop is when the Federal Reserve pumped trillions of dollars into the economy. And so people think of T-bills as cash. And so it's basically an increase in the money supply, drops interest rates because interest rates are the price of money, and you got a big push in supply. Big jump in supply means the price of money is going to come down, and it's come down close to 0 because the economy is awash with cash. Then the same thing happened with the 3-month T-bill, and the 3-month T-bill is important to us because that generally represents what many people use for the risk-free rate when we use the capital asset pricing model and we need to look at the opportunity cost of money. Well, what this is telling us is the opportunity cost of money. There isn't much opportunity cost of money. So when you buy a stock and you got to take money out of an account, well, what are you losing? Well, not much because the interest rate that you're losing out of that account is pretty small. So that's why we say the opportunity cost is low. Okay, let's go over to a 10-year note here, right? So here we're back to the 10-year. And the reason why I brought us back here is because this yield, this interest rate on the 10-year note is probably the most important benchmark interest rate out there, at least in the U.S. And that's because people look at the 10-year rate as being a reference rate for mortgage rates. And what I mean by that is, you have mortgage rates, and a mortgage rate has an opportunity cost of money, and then there's risk premiums attached to it. Well, the base rate, that opportunity cost of money to a mortgage rate, is this 10-year note, is the way many people look at it. And then, obviously people who borrow money for mortgages, they're risky. There's a chance that they'll default on the mortgage, and so there's risk premium built into it. So why the 10-year note? Many people go with 30-year mortgages. Why don't we use a 30-year bond rate instead? Well, it turns out that the average mortgage lasts approximately 10 years. They may get 30-year mortgages, but many people refinance when interest rates drop. And over the past 40 years, we've been in a market where interest rates have declined. And then also people move, and when they move, they pay off their mortgage, and they may get another mortgage as they go on to the next house. Or they simply pay off their mortgage early. And so the average mortgage only lasts about 10 years. So people conceptually, they think of the 10-year note as representing the base cost to a mortgage. And then you got to add some risk premiums on there because the average individual has a fair amount of risk. They may not pay back their mortgage. And so this will be the base rate, right, as you're seeing it. It's close to zero. Plus you're going to tack on a few percent for those risk premiums. So now with this in mind, let's go and look more closely at zeros. Keeping in mind, going over to the left here, that zeros, as we see them, produced by the Treasury, basically, in other words, created by the Treasury, the only zeros we have are 1 month, 3 month, 6 month, and 1 year bills. And beyond that, we don't have zero coupon bonds, which kind of is a problem for some people in the market, especially insurance companies and other financial institutions that want to use them for matching purposes and for risk management purposes, topics that we're going to get to towards the end of the next chapter on bonds. Probably the best way to introduce zeros is through coupon bonds. So let's start out with a 2-year bond. 2-year bond, and it pays interest semi-annually, every 6 months, and we're going to say the coupon is 2%. And we're going to say that there's a 2% yield to maturity in the world. What that means is investors are pricing this bond so that they expected to earn a 2% yield to maturity. It's what they hope to earn. And we'll see more about what that means, but what it's telling you is this is what the market demands of a particular bond of this risk. So given this risk, the market wants 2% for this bond. And by the way, since this bond is generating a 2% coupon, it's exactly what the market wants, then this bond will be trading flat, meaning it'll trade at par or face value, which is $1,000, which is the next thing we're going to assume. We're going to assume we have a $1,000 face value. Very common. Sometimes people use $100, and sometimes I might use it, but normally I stick to $1,000. And so what we want to do with this information right off the bat is map it out on a timeline. So you start out at time 0, and we're going to have 4 semi-annual periods. And so these are semi-annual periods. That's 1 year. That's the second year because it's a 2-year bond that pays semi-annually. So the 2% coupon means it's going to pay 2% over this entire year, 2 6-month periods, which means it's going to pay 1% here, 1% here, 1% here, and 1% here. And so 2% of $1,000 is $20 for a year, which means it's going to be $10 cash flow here, $10 cash flow here, $10 cash flow here, a $10 cash flow, and these are coupons. Plus, when the bond matures, you'll get your $1,000 back. So the way to look at it is you're going to invest some money at time 0. That's based on the price of the bond. And the bond will generate positive cash flow equal to this. So what we first want to do is let's figure out the value of this bond. And like I said, we don't even have to do any math since the yield to maturity, what the market is looking for is exactly what the coupon generates. This bond trades at par, or what's called flat. And so let's price the bond, meaning let's determine the price. So take $10, divide it by 1.01 to the 1 power. So I'm taking that yield to maturity, this guy right here, and I'm chopping it in half for a 6-month period. And then that amount comes out to be $9.90. So the present value of $10 discounted at a 1% rate is $9.90. Okay, so this is the present value, that's the future value, this is the discount rate, and 1 is the number of periods. And then we're going to keep doing this. Except now it's 2 periods. You're going to get this $10. What's the present value of that? Well, it turns out to be $9.80. And if we continue here, 10 divided by 1.013 to the 3rd power, $9.71. And then we take this $10 right here, and we get $9.61. And then we discount the $1,000 back. We get $960.98, and that adds up to exactly $1,000. So the bond, is set up. This bond is set up to have a coupon That's what the Treasury determined. That, for example, if this was a Treasury, the market interest rates go up and down. We've seen those interest rates go up and down in the previous a few minutes ago. We saw them go up and down in those graphs. And so here, this bond is priced at 1,000. Now, had the bond had a yield to maturity of 1%, and market participants wanted 1%, well, this would be a really attractive bond because it's paying double than 1%, which means this would be trading at a premium. So you'd be discounting this right here. This discount rate would be 1.005 to the 1. So you basically take this 1%, chop it in half, and then keep compounding it through. And you come up with a premium. Now, if this was 4% is what the market was looking for, this would be an unattractive bond. It would trade at a discount because this would be 1.02 to the 1, 1.02 squared, 1.2 to the third power on the bottoms here. Okay, so there we have basic pricing. Now, what does this have to do with zeros? Well, everything. Each one of these cash flows can be thought of as a zero coupon bond. So just this cash flow, just that $10 cash flow right there, is a zero. And so how much is that zero worth? Well, it's worth $9.90. Well, how much is this zero worth, which matures in 2 6-month periods, in other words, 1 year? Well, it's worth $9.80, given that the discount rate is 2% per year, 1% every 6 months. That's a zero, that's a zero, that's a zero, that's a zero. So you see that? And you can actually combine those. This could be a one whole zero of $1,010. Now, the discount rate associated with zeros is often called a spot rate, and sometimes it's called the yield to maturity. I called it a yield to maturity here, but a spot rate basically starts here on the spot, right? So right here on the spot, the interest rate covers this period. And so that's what we mean by spot rate. So don't get mixed up by the terminology. I'll be using the term spot rate towards the end of this video when I cover term structure. So there you have it. In one little example, what I managed to do is show you how to value a semi-annual bond, and that a semi-annual bond is composed of a package or portfolio of zeros. So what if you were to buy just a single cash flow that generated $10 in one 6-month period? Well, that would be worth $9.90, and so on. So as we'll see later, very shortly in fact, that financial institutions end up buying coupon bonds like this, and they strip out the coupons and they sell the coupons, including the principal, as what's called strips, as zeros. And so that's what we want to get to next. Let's look at strips. And so this is a good introduction to the concept of a strip. So with this in mind, let's work with a strip. Let's come up with this strip example. So here we have a strip. Now, what exactly is a strip? So this is going to be a $1 million strip. Let me give you the details. 18 months to maturity, and it'll have a bid yield 2.10% and ask yield, right, of say 2%. Okay, and let's put the timeline out here. So we start out here, and basically we have $1 million zero. A strip is a zero. It's an example of a zero coupon bond. And so basically you're going to get this cash flow 3 semi-annual periods from now, 18 months. Now what we need to do is we need to ask ourselves, well, what the heck is a strip besides just what I'm showing you here? And why do I have a bid and why do I have an asking yield? What does that mean? Well, let me explain it. As I said a few minutes ago when we looked at the yield curve, I said, look, the Treasury only issues zeros up to 1 year. Those are Treasury bills. Those are the things that we saw with a zero coupon in that column under coupon. And so the market, as I said before, the market demands, financial institutions demand zero coupon bonds that have maturities of going out to at least 30 years. And they demand those things because it turns out, as we'll see in a later chapter, that zeros have no reinvestment risk associated with them because they have no cash flow other than this particular cash flow. So there's no coupons that have to get reinvested at different rates. You don't know. So if you start out today here and you get a coupon, if you got a coupon here on a coupon bond or a coupon here, you'd have to reinvest it. And you don't know exactly what reinvestment rate it would be. So that's called reinvestment risk. I'll talk about that in the next chapter. But this guy doesn't have any reinvestment risk because there's no cash flows to reinvest. People like that. Bondholders like that. The other thing is if you hold the bond to maturity, there's no price risk, meaning you don't have to sell it at a discount in case interest rates go up somewhere. It doesn't matter because you're going to hold it to maturity. So the two main elements of interest rate risk are gone in a zero. There's no reinvestment risk, there's no price risk, and that's why zeros are attractive. Or that's why strips are attractive. Now, what exactly is a strip? Well, a strip happens when a financial institution takes a treasury bond like this, a coupon bond. Let me put this over here. So here's the coupon bond we just looked at. And what the Treasury will do is the Treasury, so here's the original coupons. And then here's the last cash flow for the principal. So what a large financial institution will do, they'll buy up a whole bunch of bonds and they'll strip the coupons off and sell them separately as zeros, and they're called strips. So a strip is nothing but a particular type of zero. So zero is like a very broad term, and a strip is more focused on Treasury securities. And so these financial institutions will strip these and they'll sell this. What do they sell it at? They'll sell it at $9.90. They'll take this cash flow, strip it off the coupon, off the bond itself, and sell it for $9.80. And this cash flow, they'll sell this for $9.71, and so on. That's what financial institutions do. Now, given that there's not a lot of supply of long-term, very long-term out here strips, then what happens is these prices are actually going to be a little higher than what it's valued at in the coupon bond. So if you think about it, a coupon bond should equal the present value of all the individual cash flows, which I did here, right? But it turns out if some of these types of bonds are not available, these zeros or these strips are not available in the marketplace, they're attractive, which means it pushes the price up. The price goes up and yield goes down. And so what happens is if a financial institution, let's say this is a very long-term bond, stripped it off, maybe the bond, instead of being worth $1,000, would be worth $1,100, and it would be worth their interest to buy up a whole bunch of Treasury coupon bonds, strip them, and sell them for the pieces for more than what it was worth as a package. So it's kind of like buying an entire new car and then pulling the whole car apart, taking it apart, and selling the pieces. And the sum of the pieces would be worth more than the car itself as a package. So that's the way to think about it. Now, let's go back. So, by the way, they're called separate trading, registered interest and principal. So what happens is, by the way, is that when the financial institutions, these are financial institutions that are given permission by the Treasury to do this. So these are interest strips right here for the coupon. And then the principal is a separate type of strip. And they're segregated because there's different tax consequences associated with the interest on a bond versus the principal on a bond. Now, back to the example here. Now, why do I have a bid yield and an ask yield? Well, these securities are sold by dealers. Nearly all securities are sold by dealers. You may see one price, but there's really two prices. And the bid price is what the dealer is willing to buy for, and the ask price is what the dealer is willing to sell for. And there's usually a spread, so they buy cheap and sell high. But when you're looking at bonds and bond type instruments, they're priced in terms of interest rates, not dollars. I mean, you ultimately have to write a check in terms of dollars, but the way they're marketed and sold on Wall Street is people buy things based on yield. So in order to have a low bid price, okay, and a high ask price, then you need a yield, a bid yield that's higher than the ask yield. Because when the bid yield is high, right, this yield is high, the price of the bond is lower. And when this yield is lower, then the price of the bond is higher. So there's two ways to disclose a bid and an ask. You can have the bid and an ask in terms of, look, you can buy Apple stock. A dealer will buy Apple stock for $100, but they'll sell Apple stock for 110 cents per share. They'll make a 10-cent per share profit. So they'll buy at this price, sell at this price. But when it's in terms of yield, it's that inverse relationship you got to take into consideration. The bid yield is going to be higher than the ask yield. Okay, so we can calculate the present value of this strip, which means we're pricing the strip. Let's price it with both yields and see what happens. Well, it's pretty easy. So if we take this, if we take the $1 million and we discount it, let's discount it at this number right here, the 2.1%. So it's 0.021 divided by 2, and we're going to discount it back 3 semi-annual periods. That turns out to be $969,150. So it's $969,150 is the present value of this strip. When this strip matures, it'll generate a cash flow of $1 million. So that's worth $969, and that's based off of this 2.1% yield. Now, what if we do the same thing and we took the million, we discounted it at 2%, right? 2% is an annual number, adjusted it for semi-annual, it's 3 semi-annual periods, it'll be worth $590, 15 cents, and the difference is about, forget the pennies, is about $1,440. So that would be the profit that a dealer would make on this strip. So a dealer will buy at this price, and that's $969. They'll sell at this price, assuming this yield, at this price. So it'll be $970, and they'll profit $1,440. I hope that makes sense. It is a little confusing, but that's the nature of bonds and that inverse relationship between interest rates and prices that shows up not just in bonds, it shows up in stocks too, as you saw in a previous video. Okay, so now we just covered a strip and zeros and coupon bonds, and we know how to value them. Let's look at a little different type of bond out there. Treasury inflation protected securities, TIPS. Treasury inflation protected. That means these things pay a real interest rate. They pay a real interest rate. What we were looking at with the coupon bond is this is just a nominal amount that's being paid out based on this nominal coupon of 2%. But what we want to look at is bonds that don't have inflation risk. What happens if you buy this particular bond and inflation shoots up dramatically? Well, the present value of this is not worth very much. You're going to be getting cash flow that's not worth too much in a high inflationary environment. So what TIPS do is they adjust these cash flows. The coupons are variable, and they adjust for inflation. So if you have an inflation rate here, it's going to be embedded in this cash flow, and this cash flow will be boosted up a little bit. And then this cash flow will be boosted up by the inflation rate in this period, and so on. That's what a TIPS will do for you. And so TIPS are looked at as very attractive in today's world because, like we saw before and I talked about, the Fed has pumped billions of dollars, trillions of dollars into the economy. And when the money supply increases like that, often we see inflation come about. So a lot of people who trade in gold, they look at gold as being a hedge against inflation, and other investors will go and they'll buy tips because tips are adjusted for inflation. So if inflation unexpectedly rears up, you're not going to have a capital loss. So let's take a look at what these tips do, mechanically how they work. It's actually really interesting. So probably the best way to introduce tips and the mechanism that keeps up with inflation is through an example. And so let's suppose that it's January 1 and we have a tips bond with a coupon of 2.5%, a principal or face value of 1,000, and let's say on January 1st the CPI is 100, the consumer price index is 100, and on June 30th, 6 months later, the CPI is 101.5. Okay, 101.5. Now remember what the CPI measures. It's consumer price index, and it measures the inflation that hits the average consumer. And so you can think of this as being the value of a basket of goods that the typical consumer buys. And let's say on January 1st, that basket of goods cost $100. And then 6 months later, the average consumer shops for the exact same goods, the exact quantity, the exact quality. Nothing changed except the prices. And let's say when they go through and they check out, so to speak, the price of those goods are $101.50. That implies that difference is that difference implies an inflation rate of 1.5%. And then we got to go one step further. Let's look at what happens when the CPI ends up to be 103.53 at December 31st. Okay? So what we're going to do is we're going to look at a TIP bond, a Treasury inflation protected bond. It has a coupon rate of 2.5%, face value 1,000, and here's what's going on in the economy. So now what we want to do is let's look to see what's happening, okay, in terms of how this bond is going to keep up with inflation. So before we go any further, we calculated a 1.5% inflation rate. Turns out this inflation rate turns out to be 2%. And all I'm doing is just taking 103.53 divided by 101.5 minus 1, and I get 0.02. It's 2%. Now the next question is, what is the inflation adjusted principal balance at the end of 6 months? So as I said, what tips do is it adjusts the principal amount, the face value amount, by the rate of inflation. So here's how to look at it. So here's January 1. And here's the first semi-annual period. Here's the second semi-annual period, January 1, June 30th, and December 31. So the inflation rate, or the CPI, was 100, 101.5, and 103.53. And so from here to here was 1.5%, 2.5%, 2%, just to keep our heads on straight. Now let's look at what happens with the inflation rate here and how it impacts the principal for a tip. So here we have the face value at $1,000 right here when we started out, and that's going to grow at 1.5% for this period. That means at this point in time, June 30th, the face value of this bond is now $1,015. It went up $15. Why? Because the inflation rate was 1.5%. Had the inflation rate been 0, this would still be $1,000. There would be no change. So then now, what will be the coupon payment on this date? Well, with a 2.5% coupon, right, we chop that in half. That's 1.25% for a 6-month period. So multiply that by $1,000 and you'd have $12.50 would be the coupon without any inflation adjustment. Okay, but now what we're going to do is we're not going to take that 1.25% here based on 1,000. We're going to take the 1.25% based on the 1,015. So multiply this by 0.0125, 1.25%, and we get $12.69. That's the first coupon payment right here, this point in time. So it's 14 cents higher than what it normally would be because of the inflation rate. So I'm just following a problem that's in the notes here, by the way, as you should know. And then the next question says, what is the annualized real rate of return for the first 6-month period? Okay, what's the annualized real rate of return for the first 6-month period? So we got to assume that there's no change in interest rates at all. And so what we're going to do is we're going to take this 1269, divide it by 1015, and that comes out to be 0.0125 times 2 because we want to put it on an annual basis. And so our return was 2.5%, exactly what the coupon rate is. So in other words, this was a real rate of return because this has been adjusted for inflation. It pumped it up only 14 cents, but that's only the first 6-month period. Now what happens if you had a bond that was 30 years? Whew, it makes a big difference. Okay, now let's continue a little further and ask, what is the inflation adjusted principal at the end of the 6-month period? The second 6-month period. Well, it's 1,000, where did I have it written here? Here it is, 1,015, and we're going to multiply that by 1.02 because that's the inflation rate here in this time period. So when we do that, we get 1,035.30. Okay, so that is now the new face value, the new principal value for this bond. So already it's going up $35. A standard regular coupon bond, that would still be $1,000. So now what's the new coupon? What's the coupon payment here? It's going to be 1,035.30 times 0.0125, that 2.5% coupon divided by 2 because it's a semi-annual period. And it's $12.94 is the coupon. Now, think about what would happen over time with that principal. So normally you'd get $1,000 back after so many years of holding a bond. So when you have a high inflation rate, it just eats away at your returns, especially because the maturity value is not adjusted for inflation. Now, before we go further, let's investigate the Fischer hypothesis of interest rates and then look at the empirical fact that real rates are negative in a lot of cases for Treasury securities, and not only U.S. Treasury securities, but government securities around the world. Many of them have negative real interest rates, which on the surface make no sense. Let me try to explain. The Fischer hypothesis says this: we have a nominal rate, which is what we're used to, equals a real rate plus an inflation premium. Now we saw interest rate yields on bonds that were around 1% right now. Okay, this is August 2020. Let's just say we have a 1% nominal rate, and let's say we have an inflation rate of about 2% right now. This is for a given year, and that's about where we've been with inflation for a number of years now. That means that this real rate has to be negative 1%. You're actually paying the government, so to speak, to buy their bonds, to hold their bonds. And why would that be? Well, it turns out that there is literally trillions of dollars in the economy, not just the U.S. economy, but worldwide. And people worldwide want to hold U.S. Treasury bonds for safety reasons. There's a lot of turmoil, uncertainty around the world. And if you want to park some money for a period of time, you don't want to put it in the stock market that makes you nervous. You don't want to put it in the real estate market that makes you nervous. You don't want to put it in the commodity market. You want to hold cash, and then you want to use that cash eventually. You end up putting it in some safe place. And, think about what are the alternatives if you're a money manager and you have a couple $1 billion under management and cash that you want to hold for a period of time. Where do you put that money? You can't put it in a bank because a bank is only insured up to $250,000. You'll go buy that pretty quickly. Where else could you do? You wouldn't want to invest in a particular company, a certificate of deposit. That's the same problem, bankruptcy. What about commercial paper? Well, that depends on whether or not the company hangs around that issued the commercial paper. So what do? Well, there's no place else to go except Treasury securities, government securities. So what people do is they bid up the price significantly, and when you bid up the price, the yield comes down. So you get a yield that's low, like around 1% at this point. And so now, how does this relate to tips? Well, in the example I gave you a little while back, the coupon rate on the tips was 2.5%. That's a real rate of interest. Well, if standard coupon bonds have negative real rates, let's just say they're 1%, then the yield, the real rate of return that ends up on these tips are going to be negative because people are going to do what? They're going to push up the price of the tips so high, they're going to bring down the yield. And the yield will be negative for tips. And that's exactly what we see. Let me show you. Here we have tip quotes, prices for tips from the Wall Street Journal. And so here on the left, you can see here's the maturity. You can see here's the coupon, what we were using. Now here's bid and ask prices as a function of 100. Now, as I told you, I often use a $1,000 face, which is standard in reality. But when you get quotes, often quotes are a function of 100. So $1,000 face value, you just chop a zero off, and it's a function of 100. Basically divide it by 10. And so here you got bid and ask prices as a function of 100. And so you got a 101.04 for a bid and 101.06 for the ask. Since these are in dollar amounts, the dealer will buy them at 101.04 and sell them at 101.06 for a small spread. Now the change in price was up just a little bit. Now the yields, see the yields are negative and they remain negative. Even the longer term ones are negative because real rates for most Treasury securities at this moment are negative. Also, the other thing to look at now, look at that accrued principal. That's the accreted or accrued principal that's been adjusted for inflation. So if you look at the very first bond that matures on January 15th, 2021, it's hard to tell, but that bond may have been a 5-year bond issued maybe 5 years ago, and it's about to mature in less than a year from now. And the principal has gone from $1,000 up to $1,174. So it has a $174 increase in principal due to inflation. And then you see another TIPS bond here, and there's an $84 adjustment for those bonds. And you'd have to go back and figure out when were these things originally issued to be able to recalculate that accrued principal. So you'd go back, figure out when they were issued, and then adjust them for inflation, and you end up, in this case, you'd end up with $1,084 if you redid the math. So it's quite interesting that real rates are negative. It kind of defies a lot of economic intuition. It's hard for me to wrap my head around the concept that people will actually pay to park money in Treasury securities. And eventually you'll get used to it because I've been looking at this for about 10 years. And eventually you get used to it because there's that much money is floating around in our economy, and people don't want to park it in anything risky at this point. So they put it in the Treasury securities. They'll take a little bit of hit, but that's bigger than a 20 or 30% hit if they put it into a risky asset that drops off significantly in price. To be clear, even before the coronavirus hit, real interest rates were negative for many countries around the world. Their sovereign bonds, government bonds, had negative real interest rates. And you might ask, well, why is that the case? Well, as I said before, it had to do with a lot of money floating around in the economy, excess cash floating around the economy. And take it one step further, that cash is waiting for opportunities to invest. Good profitable opportunities. It turns out those profitable opportunities don't exist at this moment for the most part. I mean, there's always some, but nothing really big. And the reason for that is we're looking for, as economists, for some big innovations. There's been no big innovations to lift productivity growth over the past 10 years. And so with the lack of opportunities, a lot of money is parked on the side waiting for opportunities to come about, waiting for the big next innovation wave to come about so they can invest their money for growth opportunities. So now let's move into term structure. So as soon as you hear the word term structure, it's term structure of interest rates now. And what we're referring to is what describes the shape of the yield curve. Is it upward sloping? Is the yield curve downward sloping? Remember, this is maturity and this is yield on this axis. Is the yield curve flat? Does it have a U shape? What explains that? Well, that's called term structure. And there's several models to help explain that. We're going to focus on the expectations hypothesis, because the expectations hypothesis is most relevant for what we're trying to analyze here. So before we go into term structure, we need to differentiate between spot versus forward rates, interest rates. So here's how to do it. Spot rates happen right on the spot. And so what I mean by that is they all start, the time period that interest rate covers starts right now on the spot. So if you have a 1-year spot rate, it would cover this time period, the next year. So if you went to a bank and you looked at a CD rates for 1 year, where you lock your money up in a certificate of deposit, that's a spot rate, and it covers this time period. You could also, at the same bank, get a 2-year CD, and that interest rate would be a 2-year spot rate, and you probably could get a 3-year CD, and that would cover 3 years. Those are all spot rates because they all begin right now. You drop your money on the spot in the bank, and then it goes for this length of period that you choose. Now, the question becomes in this course is, well, what are the interest rates 1 year from now and 2 years from now? Okay? We need to look at that because that can help explain these shapes, the various shapes. So let's introduce some notation. Spot rates are denoted by R with, let's call it a J, and J represents the duration. So this would be R1 for 1 year. This would be R2, and this guy right here would be R3 for that 3-year duration. So these are interest rates that cover the annual period. Okay, remember, interest rates are always on an annual basis. So you get this interest rate R, you get it for this period, and then R compounds on top of this period and compounds on top of this period. So you'll see that in the math. Now, what are these rates? These are called forward rates because this is the interest rate that starts 1 year from now and covers 1 year. So fast forward 1 year and put yourself in your shoes 1 year from now. And you say, well, I wonder what interest rates will be for the next year. That would be, at that point, that would be a new spot rate. So you'd have to fast forward yourself 1 year in advance into the future. And then if you were there at that point in time, you'd have a spot rate for 1 year. And then you could have a spot rate that went 2 years. Well, when you're standing right here, which is where we are today, these are called forward rates. And this is a 1 year forward rate. And so this is how we describe it here. A forward rate with 2 subscripts. Okay, it gets a little confusing, but it'll help you clarify what we're talking about. So right here we have F1 because I stands for when the interest rate begins. It begins at period 1, and that's what the I stands for. And then J stands for the duration. So this is period 1 for 1 period. We could also look at this forward rate, and this forward rate would start at period 2 and cover 1 period. We could have looked at this forward rate, which is a forward rate that starts 1 year from now, that goes 2 years, and that interest rate would be F12 because it covers 2 years, and so on. So that's differentiating between spot and forward rates. And so now let's look at some math and how it works, and then see how it tries to describe term structure. In other words, the yield curve shape. Okay. Okay, to move forward, what we need to do is develop a strategy. It's an investment strategy where we're indifferent between buying a 2-year security, a 2-year CD, a 2-year strip, versus a 1-year strip or a 1-year CD, and then comparing them. So here's what we want to do. So 2 different strategies. We're going to lock our money up for 2 years, and this is how it works. We're going to say, look, we're indifferent between locking the money up for 2 years at a rate of R2, right? Versus an interest rate, locking our money up for this interest rate for 1 year and then rolling it over to this period. Now the issue becomes, well, what exactly is this interest rate? We can observe what this is a spot rate. Spot rates are observable. So I like to say, look, you can spot them, meaning you can actually see them. You look at them in the newspaper, you go to the bank and they're advertised. So what's missing, or what we don't know, what's unobservable, you can't spot them, so to speak, is these forward rates. What is this interest rate that makes us indifferent between investing in a 2-year CD and, say, a 1-year CD and rolling it over into another CD? The problem with rolling it over into another CD is you really don't know what this future interest rate's going to be. You look at this and you say, wow, I can lock our money up for 2 years at this rate, but man, I don't know what's going to happen. If rates really drop, I'm going to be in trouble. I'm not going to earn much of a return. So what we do here in this analysis is we're going to assume away risk. Let's assume there's no risk. So there's no risk premiums buried in any of these interest rates. That's the first thing we want to do. And then what we want to do is we want to set these 2 returns equal. And what I mean by that is, look, if you invest in the 2-year spot, it covers 2 periods. So take 1 plus the interest rate in decimal form for that 2-year rate, compound it 2 periods, because we're going to get that rate in the first year, and then we're going to get that rate in the second year. So it's going to compound out. So this investment for 2 years has to equal the return that we get in this period, right? Compounded for 1 period, that's that little 1 there, times 1 plus F11, which is this mysterious interest rate. This forward rate is what we defined it a minute ago, but we can't observe it. So forward rates are unobservable. And so what we have is we'll be able to spot this. We'll be able to spot this because they're spot rates. We won't be able to spot this because it's a forward rate. We don't know exactly how it's going to work. But at this point in time, we have an expectation for what that interest rate will be. So that's an expectation at this point in time. What is this interest rate going to be 1 year from now? So it's often referred to as an expected future spot rate, because when you fast forward yourself in life and you go 1 year in advance, well, this becomes the new spot rate, as I said earlier. So this, when we're standing at this point in time, not only is this a forward rate, but it's an expected future spot rate. And then what is this? Well, let's give an example so we can look at this and we can analyze it. So let's say we have a 1 year T-bill rate, and let's say it's 3%. And let's say we have a 2-year strip, and let's say that 2-year strip is 2%. Okay, these are both zeros, remember, so we're on firm footing at this point. And so what we want to do is let's look at it in terms of this math and try to figure out what this missing interest rate is. Well, if you take the 2% and compound it 2 periods, right? Basically 1 plus, this guy right here. You take the 2% and you compound it 2 periods. This basically, you know what this is telling you? Look, if I invest $1 times 1.02 to the squared power, I'll have $1.404. So a little more than $1 basically is what's happening. But we don't need to multiply by 1 because it doesn't do anything. So we just get rid of that 1. It just clutters up the math. And I say, look, we're going to get 2% and compounded over 2 periods. That should equal the interest rate that I get here at 3% for 1 period times 1 plus F1, 1 here for 1 period. Notice these exponents have to add up and equal. So these two add up and equal to this exponent. So now solve for F11. Well, that's 1.02 squared divided by 1.03. And what that comes out to be, and by the way, subtract 1, and you'll get 0.01, which is basically 1%. Now, this reflects compounding. Like I said, for forever, money compounds. And so it's important to reflect that. It doesn't really have much of an impact when you're going over just 2-year period. But if you do this math on a 30-year bond that's way out here, it makes a difference between whether you compound or not compound. Now, let me give you a little bit of like the trick here to this math. Most people, they go, holy mackerel, there's squared terms, there's, all these variables, but it really boils down to something simple. So let me show you what I mean by that. Let me clean this up a bit. So we have a 2-year rate, 2%. We have a 1-year rate for 3%. Basically, this 2% is an average over 2 periods. And so if you take an average of what? It's going to be the average of this rate plus the average of this rate is going to equal 2%. So this is just arithmetic average. So what must this interest rate be to get this to be 2%? Well, this has to be 1%. So if you take 3 plus 1, you get 4 divided by 2 because we're covering 2 periods. The average is 2%. I mean, that's basically the shortcut. But like I said before, man, you don't really want to do this, especially if interest rates are changing a lot, because the arithmetic and the geometric average pull apart. When you have variable interest rates, they're basically the same when interest rates are constant. But when interest rates change over time, the arithmetic average that we're employing here is different than a compound geometric average that I'm employing here. Keep that in mind. Plus, when you do things over 30 years, that can have a magnified effect. So now let's extend the example. Let's extend the example. And so remember, we had a 1-year T-bill, we had a 3%. We had a 2-year strip, which was 2%. And now let's add a 3-year strip with a 3.5% interest rate. So basically, we're extending this, and we're saying, look, this 3-year rate, see if I can superimpose it here. It's kind of hard. This return right here, this line right here, this is R3, and that's 3.5%. The question becomes, what is this interest rate that starts 2 years from now, this forward rate 2 years from now, covers 1 period? What is that future interest rate? Well, it's going to be 1.035 to the 3rd power, because you're going to get 3.5% for 1, 2, 3 years. And you're going to be indifferent between locking your money up for 3 years at 3% per year, 3.5% per year for 3 years, versus investing it at 3% here for 1 year, versus 1% for 1 year, versus 1 plus F21, 1 for 1 year, this missing interest rate. So that's one equation, one unknown. So solve for it. It's basically 1.035 to the 3 divided by 1.03 times 1.01. Just divide both sides by this term. And subtract 1. And you get this F21. And that comes out to be 0.0658. So I will leave it to you to figure out that this is the missing component to the average, where this is an average of 3.5. And how do you get 3.5? You're going to take 3 plus 1 plus 6.58 and divide it by 3 periods to come up with an average of 3.5%, or close to it. Because remember, when you divide out this way, you're doing an arithmetic average versus geometric averages. It'll be slightly different, but pretty darn close. So one more quick question on this. What do you think the interest rate is, this forward rate that starts 1 year from now and covers 2 periods? What do you think this is? Oops, this F12. What is that guy? That's the forward rate that starts here and ends here. Well, we have all the information we need to solve for that. So think of it this way. We're looking for 1 plus F12, okay? And that's going to equal, and that'll cover, this interest rate will cover 2 periods. That'll cover 1.01 to the 1 power, and then 6.58% to the 1 power, right? And so how do you solve that? Well, multiply these together and take the square root. When you multiply these together and take the square root, you're going to get 1.0375, and then subtract 1, and you get 0.0375, which is 3.75% is the interest rate that you're going to get here and then here. And on average, 3.75 for that 2-year period. So how did I get that? Well, I multiplied these together, right? And when you multiply these together, you get 1.07646. Now take both sides, the square root of both sides. So you get rid of this. This becomes a 1. And when you have a 1 for an exponent, you don't really need it. And so when I took the square root, I basically put that into a 1. So I took the square root of this, and the square root of this minus 1 gives me the 3.75%. So arithmetically, 1% and 6.5% averaged comes out to be approximately 3.75%. So now, with this information in mind, let's look at how long-term interest rates are composed. Let's look at long-term interest rates. Turns out that long-term interest rates are an average, a geometric average, or even, like I've been showing you, an arithmetic average of a spot rate for the first year. And then it's an average of all of those expected future spot rates, which we call forward rates. Yeah, what does that look like? Well, it looks like this mathematically. R to the n, where we have n is a long number, a large number, because we're looking at a long-term interest rate. Think of it as being 10, 15, 20 years. And that's going to equal 1 plus the spot rate, the 1-year spot rate, times 1 plus the forward rate that starts 1 year from now and covers 1 year. And then 1 plus the forward rate that starts 2 years from now that covers 1 year. And so on, all the way to the last interest rate, n minus 1 to the 1, okay, where there's basically each one of these is to the 1 power. And then we're going to take it to the 1 over n power here. You know, like I took the square root because we had 2 years. That's taking it to the exponent of the 1/2. Well, if we have n years, we got to take it 1 over the nth power, and then subtract 1 from it. So what we're saying is, look, a long-term interest rate here is composed of a spot rate and a chain of expected future rates, which are called forward rates, or expected future spot rates. Now here's how we connect this to the shape of the yield curve. What if the yield curve is downward sloping? That means this long interest rate here is low. This is a low number. And it means these numbers here early on, these short rates here early on are high, but these rates are coming down in the future. So what we see here is this spot rate, which may have a 1-year maturity, which will have a 1-year maturity, is high, but the forward rates are coming down. And so that can explain the shape of the yield curve. Why do we have a downward sloping yield curve? Because interest rates in the future are expected to decline. Okay? And why is the yield curve upward sloping? Well, it means, look, this interest rate is really high. This interest rate right here, Rn, is very high at this point. And if this is high, right, but all these interest rates are low here early on, these guys are low, that means these interest rates eventually have to inch up. They have to get higher and higher and higher. So when you see an upward sloping yield curve, that implies that interest rates are expected to increase because short-term interest rates are low, long-term are high. This is long-term. This is a series of short-term. The early on short-terms have to be low. These guys have to be getting high, and that accounts for an upward sloping yield curve. And then if you had a flat yield curve, well, what would that mean? That means, well, look, Rn and then R1, they're the same thing. And if they're the same thing, that means all these interest rates are the same. So this would be 1.1 equals 1 plus 0.10, 1.10, and so on. Let's say every interest rate's 10%, right? And then you take it to the 1/3 power minus 1. We're running out of space there. It's a minus 1.0 here. Well, this 10%, 10%, 10% averaged. It doesn't matter if you average it arithmetically or you average geometrically by taking it to the 1/3 power. It's going to be 10%. So remember, geometric and arithmetic averages are the same when you have constant interest rates, which we have constant interest rates at 10%. So you can see that the expectations hypothesis that we're doing, expectations about what? Expectations about future interest rates, can describe why we have a flat yield curve, an upward sloping yield curve, a downward sloping yield curve. It doesn't matter what the shape of the yield curve is. This model can explain it. You're just going to have to plug in different forward rates to get that curvature that you want. Now the question becomes, we're sitting here and we're looking to see, what are interest rates going to be in the future? Well, we've estimated these forward rates, right? Do they actually materialize? Because remember, we're looking right here, and spot rates have already materialized. But then the question is, are these forward rates, if we calculated this to be 1%, will 1 year from now that rate actually be 1%? Well, we expected 1% here, but remember the random walk hypothesis basically says, look, anything can happen between now and 1 year from now. And if that's the case, interest rates could be higher or lower, and just by happen chance, they could be 1% in the future. So the point is, this is an expectations. Our expectations are often wrong. People buy stocks and they go negative, right? That's obviously not consistent with people's expectations. And the same thing with the bond market. So remember, if you could predict this interest rate accurately based on these we calculate these forward rates, and if this was an actual interest rate, well, we basically could predict the bond market. We have ourselves a money machine because if we can predict future interest rates, we can predict future bond prices. It's that simple. So the random walk hypothesis plays a part even in the bond market. And it plays a part with respect to interest rates. Interest rates tend to be unpredictable, which means bond prices tend to be unpredictable, sort of like a random walk hypothesis, sort of like it, with respect to bonds.